You want to buy a shopping mall, hundreds of stores, thousands of visitors a day, rent checks landing every single month from dozens of tenants at once. It looks like the closest thing to a money printing machine that real estate has ever built. You buy the building, you fill it with shops, you collect the rent, you get rich. But it is not that simple. The real story of owning a mall is far stranger, far more fragile, and far more clever than the shopping bags and food courts let you see. Because the moment you own one, you discover that a mall is not really a building at all. It is a machine for manufacturing human attention. And attention is a lot harder to keep than rent is to collect. So before you make a single dollar, look at what it actually takes to even own this thing. A regional mall is not a store. It is a small city under one roof. A typical enclosed regional mall in the United States runs somewhere between 400,000 and 2 million square feet. Mall of America in Minnesota is around 5.6 million square feet. These are among the largest privately owned interior spaces on the planet, and buildings like that do not trade for the price of a house. A large regional mall can change hands for anywhere from 100 million to well over $1 billion. So how does anyone actually own one? Almost nobody buys a mall with a suitcase of cash. They buy it the way giants buy things, through something called a REIT. A REIT is a real estate investment trust. Think of it as a company whose entire business is owning property and whose shares you can buy on the stock market just like Apple or Coca-Cola. The biggest mall owner in America is a REIT called Simon Property Group. Simon owns or has a stake in hundreds of malls and outlet centers, and it is worth tens of billions of dollars. When you picture the person who owns the mall, do not picture a landlord with a set of keys. Picture thousands of shareholders, a mountain of debt, and a management company running the whole thing like a business, because that is what a mall really is. And here is the first thing that surprises new owners. A mall is bought and sold not by its price, but by its yield. Investors use a number called the cap rate. Cap rate is simple. Take the annual profit the property throws off after expenses and divide it by the price you paid. If a mall earns $10 million a year in net income and you paid $100 million for it, that is a 10% cap rate. The higher the cap rate, the cheaper the mall relative to what it earns. And here is the tell. Malls, especially weaker ones, now trade at some of the highest cap rates in all of real estate. High cap rate sounds good. It is not. It means the market is scared. It means buyers demand a fat return because they think the income might not last. So now you own it. How does this thing actually make money? Start with the obvious layer, base rent. Every store signs a lease, and every lease sets a fixed rent, usually quoted per square foot per year. A small inline store, the kind wedged between a phone case kiosk and a pretzel stand, might pay $40, $60, even over $100 per square foot in a strong mall. Multiply that across 100 tenants and hundreds of thousands of square feet, and the base rent alone runs into the tens of millions a year. That is the floor. That is the boring, predictable money. But base rent is only the first layer. Now peel back the second one, and this is where malls get clever. Percentage rent. Most mall leases do not just charge a fixed rent. They charge a fixed rent plus a slice of the store's sales above a certain threshold. So if a jeweler blows past its sales target during the holidays, the mall automatically takes a cut of that extra revenue. Read that again. The landlord is not just renting out space. The landlord is a silent partner in every good year every tenant has. When the stores win, the mall wins twice. It collects the rent, and then it collects a bonus on the boom. Now the third layer, and this is the one shoppers never see. It is called CAM, Common Area Maintenance. The lights in the corridors, the polished floors, the air conditioning, the security guards, the parking lot, the fountain, the Santa's village at Christmas. Someone pays for all of it. And it is not the landlord. The tenants do, through CAM charges billed on top of their rent. So the mall gets its hallways cleaned, its roof fixed, and its parking lot plowed, largely on the tenant's dime. The common space that feels free to you is a line item that someone else is invoiced for. Then there is the fourth layer, the one that quietly turns a mall into a media company. Specialty leasing and advertising. Those kiosks in the middle of the walkway paying short-term rent for a cart. The pop-up Halloween store filling a dead unit for 2 months. The giant backlit ad above the escalator. The naming rights. The sponsored events. The car parked on a display platform outside the department store. Even the parking at some malls is its own revenue stream. None of this shows up on a store directory. All of it lands on the owner's income statement. And it is high-margin money. A kiosk needs no build-out. An ad panel needs no plumbing. Once the crowd is walking past, selling them a glance at a banner costs the owner almost nothing and adds up fast. There is even a fifth trick hiding underneath all of it: the land. A mall sits on a huge parcel of well-connected real estate, often near highways and dense neighborhoods. That dirt appreciates quietly for decades, and a savvy owner can carve off an out parcel for a bank branch or a drive-through, or one day flatten the whole thing and redevelop it into housing worth far more than the shops ever were. The building earns you rent today. The land earns you options tomorrow. So stack it up: base rent, percentage rent, CAM recovery, specialty leasing and ads. 4 separate income streams flowing out of one building. On paper, it really does look like a machine that prints money from every direction at once. So why are malls closing all over the country? Why did the value of American mall real estate fall by tens of billions of dollars in a single decade? Because every one of those income streams rests on a hidden foundation, and that foundation can crack. Let me show you the traps. The ones written into the contracts, in language nobody reads until it is too late. Start with the anchor tenant. An anchor is the big department store at the end of the mall. Think of the old giants: Sears, JCPenney, Macy's, Nordstrom. The anchor is the magnet. It is the reason a shopper drives to the mall in the first place. And once they are there, they wander past your smaller, high-paying stores. So the anchor is the most important tenant in the building. And here's the trap. Anchors often pay almost nothing. It sounds insane. The most important store pays the least rent. Sometimes an anchor pays a tiny fraction of what a small store pays per square foot. Sometimes the anchor owns its own box outright and pays no rent at all. Why would any owner accept that? Because the anchor is not a customer. The anchor is the bait. The mall gives the department store a sweetheart deal because the department store delivers the crowd, and the crowd is what the small, high-rent tenants are actually paying for. The whole economic model rests on this quiet trade: cheap rent for the giant, expensive rent for everyone who feeds on the giant's foot traffic. Now you see the fault line. What happens when the giant falls? In 2018, Sears filed for bankruptcy. At its peak, it had been the largest retailer in the world, an anchor in hundreds of malls across America. When it collapsed, it did not just close its own stores. It ripped the magnet out of the building, and that triggered the single most dangerous clause in the entire mall business: the co-tenancy clause. Here is how co-tenancy works, and here is why it can bring the whole machine down. Many small tenants negotiate a clause that says, in effect, I only pay full rent as long as the anchors and a certain percentage of the mall stay open and occupied. If the anchor goes dark, or if occupancy drops below a set line, those tenants are legally allowed to slash their rent, switch to paying only a percentage of sales, or walk away from the lease entirely. So the loss of one non-paying anchor can legally detonate the rent of dozens of full-paying stores. One domino, then the next, then the next. The empty department store is not just an empty store, it is a trigger. This is the death spiral of a mall, and it moves in a brutal order. The anchor closes. foot traffic falls. Co-tenancy clauses kick in, and the small stores cut their rent or leave. Income drops. Now the owner has less money to spend on CAM, so the mall starts to look tired. Tired malls draw fewer shoppers. Fewer shoppers mean more stores leave. And every empty unit makes the next tenant more likely to trigger their own escape clause. The machine that multiplied money on the way up multiplies losses on the way down. And all of this is happening while a second, slower force presses down on the entire industry. You know its name, e-commerce. When you can buy the same shirt on your phone at midnight, the mall loses its monopoly on the one thing it used to own completely: convenience. Amazon did not need to buy a single mall to hurt every mall in the country. It just needed to make the drive feel optional. Now, layer on the debt. Remember, most malls are bought with enormous loans, often bundled into commercial mortgage-backed securities, packages of property debt sold to investors. Those loans have to be paid whether the mall is thriving or dying. So when income falls but the mortgage does not, the owner gets squeezed from both ends. This is exactly what buried General Growth Properties, which owned more than 200 malls. In 2009, crushed by debt it could not refinance, it filed what became one of the largest real estate bankruptcies in United States history. It did not fail because its malls were empty. Many were still busy. It failed because the debt came due at the worst possible moment. Owning the building is one risk. Owning the loan on the building is another, and it kept happening. In 2020, CBL Properties, another major mall owner with over 100 properties, filed for bankruptcy too. The pattern repeats because the structure repeats. Big asset, bigger debt, income that depends on a crowd that can vanish. So, is owning a mall just a slow-motion disaster? No. And here is where the story turns again, because the smartest owners figured out something the panic missed. They figured out that the crowd was never really about the shopping. It was about the gathering. So they stopped selling stores and started selling experiences. Walk into the strongest malls today and count what you cannot buy online. A movie theater, a climbing wall, a trampoline park, restaurants with 2-hour waits, an aquarium, a ski slope indoors, a doctor's office, a gym, an apartment block, a co-working space bolted right onto the retail. The winning owners are ripping out dead department stores and dropping in the one thing the internet cannot ship to your door: a reason to leave the house. Look at Unibail-Rodamco-Westfield, the giant behind the Westfield branded centers. Its flagship malls are built as destinations, not shops with a roof. And look at the outlet model that Simon leaned into, where the discount and the treasure hunt feeling pull crowds that full-price retail lost. The malls that are dying are the ones that stayed shops. The malls that are thriving turned themselves into town squares that happen to sell things. Same building, completely different economics. So picture the two futures that sit in front of you the day you buy one. In the good future, you own a well-located mall in a dense, wealthy area. Your anchors are strong or already replaced with experiences. Your occupancy is high. Your percentage rents are climbing. Your CAM is fully recovered, and your specialty leasing and advertising revenue grows every year. You are not a landlord anymore. You are the operator of the most valuable gathering place in the region, and the land under you might one day be worth more redeveloped than it ever was as retail. That mall is a machine, and it is running. In the bad future, you own a mall in a fading suburb. An anchor goes dark, co-tenancy clauses fire, rents fall, CAM shortfalls pile up, the mortgage keeps demanding its payment, and the building slowly hollows out into what people online will one day photograph and call a dead mall. Same 4 income streams, same clever contracts, but pointed in reverse, dragging the value down instead of up. The difference between those two futures was never the building. It was whether the crowd still had a reason to come. So the next time you walk into a mall, look past the shops. Notice which store sits at the end of the corridor, and ask yourself whether it is paying full rent or paying almost nothing to stand there as bait. Notice who is cleaning the floors. And remember that a tenant is being billed for it. Notice whether the place is selling you products or selling you an afternoon, because you were never really the customer wandering through a building. You were the foot traffic. And in the economics of owning a shopping mall, the crowd is the whole machine. It looks like a money printing machine. It only prints for as long as you keep showing up.